The thing that I think, and Vinky, we've done this. You and I have done this. This is our fourth or fifth or sixth conversation, right? We've gotten to know each other. And that I think is something that in the real estate game is one of the most important things you can do is create social capital, create the time, create the opportunity, create the understanding with people that you can be helpful to and that can be helpful to you in your real estate journey. The one thing that I've learned more than anything in this is that real estate is a team sport, and it really, really is. The more people you know, the more likelihood you are to be able to find a deal, to make a deal, to help a deal, to do a deal. All of those things take other people in your world. And the sooner you do that, the better off you're going to be.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very good friend, Shannon Robnett, with me. Welcome, Shannon, to my show.
Hey, Vinky, it's good to see you again. It's been a while.
I know. It's always a pleasure to see you. A little bit about Shannon. Shannon is a second-generation builder, fourth-generation realtor with over 250 million in personal transactions. Shannon is an active syndicator in many markets with over $100 million in assets under management. Shannon is also building out a digital securities platform for investors and syndicators to create wealth and liquidity using blockchain technology. And we're going to be talking about that in our summit on February 25th and 26th. So if you haven't signed up, please go to multifamilyinvestoreducation.com and sign up for the summit. Today, we're going to be talking about the debt funds and first position investments because they have become increasingly, I think, popular in the recent years, and they offer investors an attractive way to generate superior returns in the current market environment. These type of investments come with higher risk, but they also have a potential for higher returns than any other investment options. So today, our topic of discussion is debt funds and first position investing in the current market for huge returns. So, Shannon, I'm going to ask you this question. If you can briefly share your background with me, how did you get involved with debt funds and first position investments?
Well, Vinky, I've been involved with real estate my whole life. And, as you get through different stages, you look back and you go, gosh, I could have maybe navigated that better if I would have had this, or if I could have done that, I could have maybe allowed these things to happen. And one of the things that I look back on coming out of 2008 and 2009 was the fact that there were a lot of opportunities available to people that had access to rapid cash. And it wasn't that the asset was necessarily risky. It was what was the real value of the asset. We've seen a historic run up in real estate assets. And as I watch these things and I see how my whole life I've been looking at this deal and I've been underwriting this deal and I've been building this deal and I've been doing this deal, we built everything from hospitals to schools to police stations, fire stations. We've done the gamut, and all the time you always see a better way to do it. And so when I've done all this stuff, I've just kind of kept building an encyclopedia of things that I can do that when the opportunity becomes available to me, then I put the team together that says, hey, we can step out and we can do this, and we can do it in a way that makes sense, and we can do it in a way that establishes real value and real protection, because the history, the 30-year personal history that I have, plus my advisors and my teams that allow us to move with decisive accuracy in situations like that. So that's kind of how I got where I'm at right now. It's just been 30 years to become right here, right now, today.
Great. So can you explain briefly what exactly debt funds and first position investing is and how they work in the current market?
A lot of people listening to your show are probably pretty familiar with the syndication model, where you've got the bank is in first position, the general partner signs for all those loans. The LPs are not really tied to the asset at all, which gives them that protection from the loan and all that kind of stuff. What I'm looking at is there are a lot of really great assets out there right now. And I know of a dozen that we're looking at right now that are fantastic assets in strong markets, in great positions where maybe somebody took advantage of a floating bridge loan. Maybe they started out at 2.5%. Everything was fine. Now that floating bridge has moved itself to 9% and they're in trouble. They're underwater. They're losing money on a cash flow basis, and they don't have the reserves to withstand that. I know that there's a lot of people in the Texas market that have experienced their insurance rates have doubled over the last year because of the freeze that happened 2 years ago. And you know how insurance companies like to come back and get their money back from you. And so now all of a sudden their asset went from a cash flowing asset to a net negative asset, and they don't have the ability to refi, and they're coming to the end of a short-term bridge loan. And quite frankly, I've been in that position. And so looking at what the options are available to you when you're in that position is something that I've looked at, and I said, hey, I think we can create a better solution for this that allows people the opportunity to deal with that problem in a way that makes sense and protects investors by going into a first position situation that allows for everybody to get a very great return in an asset that right now banks don't really want to look at, but maybe is still a very solid income producing asset.
Wow, that's great. And I think the way I understand is debt funds and first position investments, typically they offer higher returns compared to the traditional real estate investments. Is that true? But there's a higher risk as well, right? So I wanted to hear your perspective on these kind of investments compared to the traditional real estate investments.
You know, I think the thing that everybody wants to do is they want to de-escalate the risk, right? We're in a part of the market cycle that isn't as rosy as it was 18 months ago, where everything was headed for the moon and everything was only going to get better. But the reality is, at the end of the day, if you're looking at it, I know of one particular asset that is it's a retirement sale. It's a $9 million asset that you could probably purchase it for about $7 million today if you could write a check for it. When you put get the old tenant out, you put the new tenant in, the asset will be worth $9 million. This is an asset that a bank wouldn't necessarily loan on because there is no tenant. Cash flow that's looking to be coming out of that can be financed because there's enough debt to equity in there that allows you to be at a $6 million note, right? On a $9 million asset is 60% loan to value. So when you look at something like that, you're able to step in and say, hey, I can do this deal and I can finance this with interest for a period of a year for you to buy the asset, get it stabilized with the new tenant, and create a $9+ million asset. In the meantime, if you default, I'm going to take the asset at $6 million and I'm going to be in a very protected position. And what it does for the investor, Vinki, is that it puts you in a higher cash flow situation because people are in different stages in their investing world, right? Some people are looking for appreciation. Some people are looking for tax protection. Some people are looking for cash flow. And a lot of times, especially in this market where interest rates are high and prices are still fairly high, it's difficult to get the cash flow that a lot of investors want. But if we are the actual lender and we're getting a 8.5% interest and we're getting a couple of points on the deal, and all of this is pre-funded interest and all of those kinds of things are built into the deal at a 60% LTV, then all of a sudden I can return to my investors a really strong cash on a monthly basis, not a ton of upside, like a 20% IRR. But if you're looking for strong cash flow from day one, I can get you into that, 9 to 11% range right now in a world that doesn't have those kind of opportunities available for cash flow. And that's the beauty of this debt fund. And those are the beauty of being flexible, but also understanding real estate as the fundamental underlying asset and being able to derive a real value from what you're investing in.
Wow. So let me ask you here this question. Can you share one example of your successful debt fund and first position investment that you were involved with in the past? and you have done successfully?
Sure. So the building that we're currently in right now,
Mm-hmm.
this is a situation where we were able to pull together a fund and finance the building. We were able to get a 6% interest loan on the building. And with that, we have investors that are making a 6% interest, plus they got their fees, plus they got their, loan origination fees and their different fees like that. So it really wraps up at around 9.5%, but that's paid every month, right? So they are in the money from day one instead of with a lot of syndication events. Those are more about tax savings in year one and year two. They're more about appreciation in year two and year three. And then there's a big paycheck in year 4 and year 5, right? This particular building is just something that from day one, it's producing 9%, 9.5%, and it will for the whole duration of the 2 years that we're invested in this. The other thing that a lot of people look at with a debt fund is they look at something that, you know what, I don't really like the market out here right now. It's kind of choppy. It doesn't look great, but I know in 12 months or 24 months, it's going to be better. But I can't leave my money sit in the bank right now. So I've got to do it. I've got to make an investment. So investing in a fund is a great way to keep your money working for you, but still have liquidity that you can retrieve it in a couple of years or in 18 months when you feel better about the market and want to do something different.
Wow. But how do you find these deals? Because thorough due diligence is an essential step in real estate. Doesn't matter what kind of investment you get in. And this should include maybe comprehensive review of borrowers' financials or meticulous analysis of the collateral. And plus, you wanted to ensure the terms that you're getting in, all the loan terms, whatever is aligned to whatever you're trying to do. So can you kind of walk me through what is your due diligence process, or how do you find these deals? Those are beneficial by the end of the day?
Yeah. So, it's funny. So I've been in real estate, my whole life. And so I've just kind of created a network. And when you start to talk with other people about, hey, if you see any deals where people are looking maybe for some private financing or some debt funding or stuff like that, then it really kind of starts to spread. And I see probably 2 or 3 deals a week of people looking for debt funding that maybe it's a little bit non-traditional. And, the reality is, Vinki, I don't really spend a lot of time underwriting the operator. I spend all my time underwriting the asset, because at the end of the day, I look at it and I plan on taking the asset back. Not that I want to, right? But if you look at a bank does not want the asset back. They don't want to deal with the situation. They're not set up that way. They don't see the opportunity. They don't see the value. I do. So I look at it and I go, let's look at the asset. And if I know that this is a $20 million asset, I know that I can comfortably loan $12 to $14 million on the asset in the market that it's in and still leave plenty of upside for me, right? And I'm not willing to loan on blue sky, right? So if this asset is something that you've had, and let's just say you bought this in 2017 or 2018, and you put a variable rate bridge on it, and you did a 3-1 interest only, coming to the end of that, and your insurance went up and your NOI went down, and you're just not in a position where you would have to come in with another $1 million to get another loan on this thing, and you're just kind of in a spot. And we look at that and we go, wow, Vinki, this is a really solid $20 million asset. I know you only paid about $12 million, $13 million for it. I can come in and take out your primary bank. I can give you credit for the upside that you have, but where your debt service coverage ratio may not work with a traditional bank where they want to see a 1.25 or maybe a 1.35 on something like that, I can look at that and I can pre-fund the interest and go, I can pay off your first and I can take care of that. And then we'll go through a position here where hopefully rates will come down a little bit in the next couple of months. You're working on getting your NOI up again. You're working through some issues with your insurance companies, blah, blah, blah. All those kinds of things where I can come in and I can say, this is really an asset that I wouldn't mind buying. And I think the value's there at 20 million bucks. And I could definitely see myself in a position on a loan at 60% loan to value, 65% with interest. And I could come in and make that loan to you, right? And so when we're able to do that it gives people relief because we've built in an interest reserve, we've built in the fees, all of those kinds of things that allow the breath of fresh air, allow you to get back on track, allow you to, do the things that are necessary to work through the business plan in that 12 to 18 month range. And we're in first position. So if something happens to you, that would be very unfortunate. But the reality is I have the ability, I have the team, I have everything necessary to step in and operate this asset that a bank wouldn't necessarily have. And I wouldn't be afraid of that. If it went all the way down the road, I would just start the foreclosure process and repossess the asset, right? Not something I would want to do, but when I underwrite, that's my thought process, right? So it's not that I'm being predatory. I'm actually being very helpful because I'm offering a solution that a lot of banks wouldn't. And I'm able to do that in a way that allows you to get out from under the stone that you're under right now, find a place of stability to get that business plan executed, where we've seen cap rates surge. They've gone up right now. Maybe you just need a couple more months, another year, and you're going to have things stabilized and you're going to be okay. And everything will be back to where it should be.
Okay, so you will have the first position on the loan because you're taking over the loan from the bank. So bank is out of the picture completely. So you are the new lender, right?
Correct.
And how long is going to take for the whole process?
Well, we should be able to move in less than 30 days. And so we will come in, we will clear the liens, we will see what's there, we'll do our due diligence. We'll, if this is in Baton Rouge, we'll go to Baton Rouge for a couple of days. We'll do our due diligence. We'll make sure that everything is what it's supposed to be. We'll be boots on the ground. We'll understand the asset in its entirety, and then we'll move forward to being that lender and taking that out and solving that problem. We also work with people trying to acquire things that are quote unquote on sale because of someone else's duress, and be the backup, be the lender for them because we can move quicker than a traditional bank or other funds like that. And that allows us to get great returns for our investors, especially as interest rates continue to tick higher. Deals are making sense. If you look back on it, Vinki, 4 months ago, deals didn't make sense at 8% interest. Now we're starting to see sellers get reasonable and deals are starting to make sense at 7, 8, 9% interest. As interest rates continue to march upward, which I think they're going to do over the next quarter, next maybe even 2 quarters, we're going to feel more comfortable charging 10 and 11%, 12 and 13%, because that's what the market's going to bear. And then I believe toward the end of this year, you're going to see rates come back down. Maybe not necessarily in a substantial fashion, but that will allow for all of this to kind of right side and people to be able to see cap rates come back down, lending come back up, DSCRs get more back in line.
So are you guys statewide? That's the first question I want to ask you.
Nationwide.
Nationwide. Okay.
Yep. We're do the only we won't go. We look at landlord laws. We look at lending laws. We will not go to California. We will not go to New York. Those are a hard pass for us. But most states we don't have too much trouble looking at that and becoming your lender.
Okay, so next question I want to ask you is how long is a loan? What does a loan term look like? And what is the difference between the interest rate, the market interest rate, and what are you charging? How much is the difference?
So what we look at is it's based on each asset. It's based on the business plan. So obviously the shorter the loan, the higher the rate, because there's a certain amount of brain damage that happens with every deal, right? You've got your loan origination fees, you've got all the other things you're doing. And so at the end of the day, we look at each one on a case-by-case basis. But let's just say if you could get a CMBS loan today for 6%, we're going to be 9.5 and probably 2 points, 3 points. But we're going to move quickly, and we're going to be something that's going to be able to take care of the situation for you and or move you into an opportunity that the price is right and is going to allow you to take advantage of something that if you were to go with traditional lending would not allow for, just because of the timing of getting it all done.
You mentioned long-term loan and short-term loan, and the interest rate is kind of derived by the length of the loan term. So what is the difference between the two terms? Like how long is the loan term?
A long-term loan for us would be 18 months. A short-term loan would be 6 months. So, what we're looking for is we're looking to be call it your hyper bridge. We're something where maybe you're running out of bridge money. We had a situation right now, Vinki, that we're looking at, that the borrower does not have any more capital to put in the deal. They bled themselves dry. They don't have any more capital put in the deal. They're at about a 52% loan to value, but without any more capital put in the deal, it's hard to get a lender to step up when they can't put any more into the deal. So we're able to come in, take out the bridge that's expiring, give them the lifeblood to finish the remodel that they're doing on their project, get it done, get it stabilized. And in that 12-month period of time that we're looking at, they'll be able to bring that value into their value add and put themselves in a position to do a takeout loan. If we come into a situation that they're not, we're more than happy to assume the asset and move forward from there.
I'm thinking out loud here. So what are some of the common mistakes that someone can make that you can share some light on?
We've seen a lot of people that have gone into buying deals where they've paid an absolute premium for it. First part of 22 was a great time to overpay. And a lot of people in 19 got into deals thinking that, this 2%, 3% interest rates were going to be there forever. So save 0.5% and get a floating rate loan. And now that interest has gone up to 9.5%, 10% on those floating rate loans, and they're underwater. They're not cash flowing every month. Banks really, really don't like it when you don't pay your bills. I don't know why, but they really don't. And so when you get into that kind of a thing where your underwriting requires you to have that kind of cheap money and you don't have it anymore, you go backwards pretty quickly. And then what tends to happen is when you start to look at places to cut, you cut on your management, you cut on your maintenance, you start deferring things that really need to be done to keep the asset in top condition to get top rent. And so then you start to see people go into this downward spiral very quickly, and they start to get, instead of getting $750 headed for $800 rent, they're going the other direction, getting $800 going for $750 because they're only cutting the grass twice a week, and they're deferring the paint job, and they've got maintenance items that are open, and they went with a cut rate management company. And so it just goes from bad to worse because, like a lot of things, when you start to focus on, oh my gosh, I've got to absolutely mind all my pennies instead of look at the value that you get by spending the money on the asset, then you tend to see some of those mistakes amplify themselves and become worse.
Wow. I think it's a little bit complex kind of thing. It's not that easy to understand. So I will just say, understanding the complexity of this debt investing or the first position, it might require some specialized knowledge that you have gained over the years,
Absolutely.
So what advice do you have for the investors looking for this kind of position in the current market?
If investors are looking for short-term strong cash flow, this is a great opportunity for them to get involved with something like this because it's not a 5 to 7 year commitment, which is a typical syndication commitment. If people are looking for this kind of debt, it is expensive, but when you're able to buy things at value pricing, or you're able to turn an asset around that you were going to lose, it's all relative. And so what I look at when people look at this kind of thing, it's a great interim thing. It's a very short-term thing, but it allows you to either recognize great gains right now, great cash flow right now, and allows you also, if you're this close and you need to get over the hump, this is usually something that allows that product to happen. But you are exactly right, Vinki. You need to know your asset type. You need to know your submarket, and you need to make sure that you're in a lending position that will not be devalued and put you in a position that you could maybe be underwater on the asset yourself when you take over if you have to.
That's true. And plus, it's very important to consider the current market conditions, like the interest rates, economic indicators, and also the performance of the asset itself, to determine if it's a debt fund or the first position is a viable option or no. But, how do you think the current market is supporting this kind of opportunity?
Well, I think that there's a lot of liquidity in the market, which is good. I think that that's strong. I think that that's a lot different than what happened in 9 and 10 and 11 when the liquidity dried up. What I think is hurting people right now is the debt service coverage ratios, where you have to be able to have this asset cash flow. We're not necessarily looking at the asset cash flowing because we're willing to pre-fund some of that interest. So I think we offer an opportunity there, but I think that a lot of people are looking at it and they're seeing that the market is still strong. Real estate transactions are still happening. Sellers are getting more reasonable. Things are taking maybe a little bit longer to sell, but overall, we're still getting that done. And I think we're still seeing rents continue to escalate. I think we're still seeing, opportunity for growth in the real estate market. So I don't think we're going to wind up with a stagnant or a backtracking real estate market much more than what we've seen currently. Because if we look at the astronomical rise that we've had over the last 5 years, we've had a serious increase in asset product costs. And now we're seeing maybe a little bit of retrade down a little bit lower, but I think we're still going to see a very, very strong real estate market moving forward, which means that the asset that you're in today will be worth more in the future, and you're not going to be in a situation where you find yourself too far underwater.
As trend plus market goes through cycles, it doesn't stay at the same place all the time. You have to remember that because we're looking into the long-term position. It's not like something right here, right now. You mentioned a term hyper bridge. So this loan type you consider as a hyper bridge between 6 to 18 months. So what's going to happen after 6 months or 18 months? They have to go to the agency loan, or they need to refinance or do something else with the loan?
Yeah. So we want to make sure that you've got a solid business plan that makes sure that you get there, so that at the end of the day, we know that you're going to be using our product, but you've got an opportunity, you've got a business plan that gets you out of there. So at the end of the day, really making sure that we are helping you, not putting you in a position where we have to repossess the asset, even though we wouldn't be afraid to, but putting ourselves in a position that this is something where you have made a good decision, you put your business back on the right track, and things are now moving forward for you so that you can get that last little bit of growth, get over the hump and get funded and get to your next plateau.
Yeah, I think this might be good for a lot of people if they are underwater a little bit, And the way I look at it, Shannon, correct me if I'm wrong, is something like that, if your asset is underwater, you're just trying to kind of revamp that, writing a new business plan. It's like acquiring a new asset. You're starting a new loan, and you're going to see where you can take this asset 6 months from now, 18 months from now. It's like a brand new, you're getting another opportunity or the second chance to revive your asset. Yeah. But you're starting from the scratch. Is that a true statement?
That's exactly right.
And then I do have one question in my mind. A lot of things in the real estate industry happens through the relationships. If somebody's looking to find some lender like that, or they wanted to build you need to have the relationship with the lender or some kind of prior, introduction, something in order to get this kind of agreement. Like you were saying earlier, you do not pay attention to the operator, but still you wanted to see the track record, or if they're gonna, fly with the business plan or not, because you don't want it to have multiple assets under your belt too, right? Or do you have the bandwidth to take over the world, all the distress assets?
Yeah. So we're pretty selective. And when I say that, it's not that I don't pay attention, because you want to make sure that you're doing business with good, smart people.
Exactly.
At the end of the day, the business plan has to be executed. But, I know a lot of times the bank puts a lot of weight in who the borrower is, and maybe gets out a little bit over their skis with what they're willing to loan you because of your track record. We look at your track record as something secondary. We look at who you know as something secondary. We look primarily at the asset, because at the end of the day, that's what we're going to have to work with if you're no longer in the picture.
Great. So I'm going to ask you one question here, like what kind of suggestion or some tips that you can share building some relationships or the strong relationship with somebody like you?
The reality is, this is something I learned a long, long time ago. You always want to create relationships before you need them. You always want to take the time and the effort to get to know the people, so that you're not absolutely in a panic trying to find something at the absolute last minute. And if you're creating those relationships and you're understanding the proximities and you're understanding what's going on in my world and I'm understanding what's going on in your world, when that call comes, it puts us in a lot better position to be able to help each other in a quick and efficient manner, rather than to be able to be sitting there in a panic and go, oh my gosh, we've got to hurry up and do this. We've got to do this. We've got to do this. Right. So I would suggest that you create those relationships and create those networks long before you need them, because then when you need them, we already know each other and we already know what the parameters are. And that's really efficient. And it's really something that I think a lot of people don't put enough effort into, is getting to know their options before they need them, and then they're scrambling. So always create the connections, whether you feel you need them or not, and then you've got something to go from there.
I like that. So we are out of time. Can you share one golden nugget with my audience?
The thing that I think, and Vinki, we've done this. You and I have done this. Mm-hmm. This is our fourth or fifth or sixth conversation, right? We've gotten to know each other. And that, I think, is something that in the real estate game is one of the most important things you can do, is create social capital, create the time, create the opportunity, create the understanding with people that you know you can be helpful to and that can be helpful to you in your real estate journey. The one thing that I've learned more than anything in this is that real estate is a team sport, and it really, really is. The more people you know, the more likelihood you are to be able to find a deal, to make a deal, to help a deal, to do a deal. All of those things take other people in your world. And the sooner you do that, the better off you're going to be.
Wow, I love that. Social capital. Everybody remember that. So this brings us to our rapid fire round. And I'm going to ask you 5 questions, Shannon. You're going to answer in one word or one sentence only. Are you ready?
Yep.
All right. So the first question is, what is one of the most important things that you have learned in your life that worked for you all the time after learning it?
Tenacity. You have to keep going.
I love that. Awesome. So share one good book that you read and you liked it.
Chris Voss, Never Split the Difference.
Oh, that's a good one too. In one word, what does life mean to you?
Freedom.
I like that. What is your biggest passion?
Helping others.
That's a really good one. That's very close to my heart. It's always, I like to give more than I take. That's what makes a difference, because we are here to help each other grow. I love that. Thanks for sharing that. If you can turn back in time and talk to your younger self, what would that be and why?
I would actually tell myself to get a job. I've never actually worked for anybody else. And it would be nice to have learned a lot of the things that I had to beat my head against the wall to learn from other people by working in their system. So I would tell myself, go get a job.
Good one. I never heard that before. Okay, how can people reach out to you, Shannon?
Just shannonrobnett.com, or you can send me an email at connect@shannonrobnett.com. I'll connect you with all my socials and we can go from there. Love to have the conversation.
Awesome, Shannon. I just wanted to remind everybody, if you like this show, please join us for our summit, Multifamily Investor Education Summit on February 25th and 26th. Shannon's going to be there with us again, talking on blockchain, and he's going to share so many secrets there. So if you haven't signed up yet, please go ahead and sign up. Go to multifamilyinvestoreducationsummit.com. Sign up there for the summit. Thanks, Shannon. It was a delight to have you with me today.
Thank you, Vinki.